Lately, there's been one word on everyone's mind: recession. It seems like everywhere you turn, there it is. Either it's people arguing a recession is coming, or it will be narrowly avoided, or maybe it's happening right now. What we are in agreement on is a recession is pretty but no one seems to have any idea whether or not we're actually, in one. What we do know is a lot of bad stuff has been happening. We know stock prices have been cratering, inflation is sky high, and Google searches for the word recession have been spiking, along with Elon kids. Coincidence? Maybe, but does any of this mean a recession is definitely going to happen, or that it's already happening? Things feel bad. The vibes are very, very bad right now, and the economic health of America, really the whole world, does to a certain extent depend on vibes. Seriously though, so much of our economy's health is about investor and consumer confidence. It's about whether people are using their money or saving it. But a dash of bad vibes doesn't necessarily mean that we're about to enter a full-on recession. They could just mean the vibes are bad.
I declare bankruptcy!
Now, there is one data point that generally is accepted as proof we are in a recession: 2 consecutive quarters of GDP loss. This is according to the National Bureau of Economic Research, the people who get to officially call a recession. They're kind of like referees of financial policy. We've had 1 quarter of GDP loss, and the next quarterly report comes out on September 29th. And if that shows another quarterly loss, that's it. Blow the whistle, flag on the play. We're in a recession. But see, the problem is that won't mean the recession started on September 29th. It means the recession has already been happening. It's only at that moment that the data is conclusive enough that these economists feel comfortable officially calling the vibes bad. So yes, come September, we will all know whether we are actually, really, truly in a recession. But that doesn't solve our question, which is what's happening with our economy right now. Some recessions are caused by one-time insane events that have never happened before and just send the entire world into a state of turmoil. Events like a world war, a global terror attack. The 2001 recession was caused by a black swan event, the dot-com bubble bursting. So was the 2008 recession, when the housing market collapsed, as well as the relatively short 2020 recession caused by COVID and subsequent lockdowns. Black swan recessions are always easy to identify, easy to call, but this time, there isn't one single event that we can look to and point the blame at. There's a ton of factors at play here, so we need to look at other indicators, and there's a lot of indicators right now, but none of these are foolproof. People debate all of them all the time, and that's our question. Is it really a recession or just plain bad vibes? Now, what's good vibes, real quick, is today's sponsor, KuCoin. How's that for a transition? I've been using KuCoin to lend out stable coins for the last year now, and while rates are down with the market, I'm still accumulating and have earned over $25,000 in interest doing essentially nothing. You can check them out, linked in the description below. I use them for all kinds of stuff. It's a one-stop shop kind of platform that offers a ton of features. Check them out down below if you're interested. Now, the stock market this year has not been pretty. In June, the S&P 500 entered a bear market, a time when stocks decline at least 20% from their recent peak. Bear markets are pretty rare, and they frequently come before, you guessed it, a recession. Side note, I feel like I'm gonna be saying recession so many times in this video, so sometimes I might just mix things up and say R word or the big R, things like that. Try some phrases out. Yeah, bear market equals bad. But there are a lot of people in America who don't own stocks, and a recession is something that affects absolutely everyone. It hits lower income Americans as well as members of the investor class. So the movements of the stock market alone, they haven't ever been considered conclusive proof of a recession. All stock prices really prove is how stock investors feel about the stock market, whether they feel hopeful or scared or bullish or fatalistic. Again, it's all vibes all the way down. That said, not all stock prices are created equal. The price of hot tech stocks are massively driven by investor confidence, but the price of commodities, things that actually exist in the world and are needed for the world to run, that price is directly correlated to the global supply and demand. So it can tell us a bit more. And there's one commodity in particular that gets a whole lot of attention whenever the word recession starts getting thrown around: copper. Copper can be such a great predictor of global economic trends that it was given a prestigious nickname, Dr. Copper. But why is this? Why is the price of copper such a good fortune teller? A few reasons. After iron and aluminum, copper is the 3rd most consumed metal in the world, and it's one of the most versatile. It's used in everything from construction to tech, energy, and basically anything else that you can think of. So if stuff is being made, chances are copper is being used. And you might ask, thinking about the recession, hey, Dr. Copper, how you holding up? And he or she would respond, not great. In fact, in just the first week of July, it hit a 20-month low, even while other stocks in the market are starting to recover, indicating a renewed investor confidence. Copper, it just keeps going down. And a lot of people would argue that this is proof that our problems are worse than they seem. Now, the other word that you've probably been hearing a lot lately, maybe even more than recession, is inflation. Every recession since World War II has seen an inflation hike first. The Consumer Price Index, which is one way to measure inflation, is at its highest level in 40 years. No matter who you are, what you do, where you live, what sort of lifestyle you have, inflation will hit you. I'll tell you about my worst hit. I own a moving and storage business. My warehouse rent went up 55% in 1 year. And when everyone starts getting negatively affected in one way or another, that causes a change in consumer confidence. There's something that's called the Michigan Consumer Sentiment Index, a highly respected survey of consumer confidence. And this last June, they found consumer sentiment to be at the lowest recorded level since they started doing the survey 70 years ago. This is the perfect storm. It's bad data and even worse vibes. So based on all this, it seems like a recession is absolutely, definitely 100% happening, right? Well, there's also some hopeful data coming out. Data that some people have been using to back their claim that we have not entered a full recession and we won't. That we came close, but the worst is actually over. We managed to get control of the car and steer away right before crashing into a tree. For instance, real-time data shows that shipping rates are likely going to decrease over the next 6 months. Used car prices, a good indicator of inflation, have now flatlined. Commodity prices are still going down, which is not good for the market, but when the price of commodities goes down, so does inflation. And folks, that's not vibes, that's facts. So in this case, the lack of investor confidence thanks to the fear of a recession might actually help us avoid a recession. It's like not wanting to go out because you think you'll get sick. So you stay in and you don't get sick. And it's like, yeah, I guess that logic works. Meanwhile, the Federal Reserve is doing what they can to make this hope a reality, using interest rates, the most powerful tool they have. The only problem is, if they use this tool wrong, even by just a fraction, they might very well cause the recession that they're working so hard to avoid. When the Fed raises interest rates, as they have done in the last few months, what they're trying to do is achieve something called a soft landing. This is where the raised interest rates curb inflation just enough, and they save the economy from a far worse outcome.
I just want to tell you both good luck. We're all counting on you.
A totally successful soft landing, however, is very rare. It's so rare, it's actually only been achieved in American history once, in 1994. You want to raise the interest rates just enough to counterbalance inflation, but not so much that the interest rates themselves cause the economy to contract. It's like a chef preparing some really demanding, delicate piece of meat, like a squab or, some other bird like that. If you undercook it, it's rubbery. If you overcook it, your dad and everyone you know loses their job. But actually, it's worse. Every move the Fed makes is being highly scrutinized and immediately priced into the extremely unstable stock and crypto and commodity markets. An increase in interest rates, if done too aggressively, can cause an inverted yield curve. That's what happens when shorter duration bonds surpass long-term bonds, a sign that bond investors think that the economy is not going to get better anytime soon. And an inverted yield curve is often used as a strong indicator of, that's right, the R word. So really, it's like the chef is cooking the squab, but she's doing it with one eye closed and one arm tied behind her back. Squab talk aside, we need to remember that we exist in a global economy, and there are so many factors that impact America that America can't really control. Most headline inflation items like energy and commodity prices are set at a global level. And so it might not matter what the Fed does. Maybe it's all outside their control. So I guess it's kind of like a chef preparing a delicate piece of meat with one eye closed and one hand tied behind their back. And she's also working in a kitchen that's on fire, in a building that's collapsing, in a city that's experiencing a level 7 earthquake, all at the same time. Can she still prepare the squab right? Maybe, but it won't be easy. Okay, so let's assume a recession is coming, or let's assume it's already happening. How can you protect yourself from losing too much? Or even how can you make some money during this time? A market dip, as we know, is often a great time to invest. A lot of people getting spooked right now are panic selling, and this could breed opportunities, but it's still risky. We don't know when the market will hit bottom. So if you want to try and buy low, here's a few general things to keep in mind. This is not the best time to invest in any company whose fortunes are highly determined by how Wall Street feels about them. Instead, you should look for industries that are considered recession-proof, companies that actually make things, that actually do things. Think about utilities, healthcare, consumer staples, stuff people need, made by companies with healthy profits that will survive a recession. Another tip that some investors use when buying in a downturn, although it can be a bit controversial, is utilizing something called a negative correlation. You diversify your portfolio with asset classes that tend to move in opposite directions. If one asset class takes a big dip, the other will tend to go up in value. Things like oil prices and airline stock, real estate companies and investment banks, video games and condom brands. You get the picture. But keep in mind, you should only be investing if you've already got some money saved. This is the time to first put aside some emergency cash reserves if you don't already have them. And also, just as important is getting yourself out of debt. If you have any high interest debt, this is where you're really going to feel it. If you currently have a balance on a car, do whatever you can to pay it off. Beg, borrow, steal, whatever you need to do to get rid of those crazy interest rates. And if you can't pay it off all at once, maybe you want to consider transferring your debt to a low interest rate card or consolidating. If you're a longtime customer with a history of paying on time, call your credit card company and see if you can negotiate a lower interest rate. They might do it. Just do anything you can. Don't sit back and watch this crazy interest pile up. But also, do not cancel your credit cards. Not right now. Credit scores are going to become more and more important in the next year, and the age of your accounts is a factor when trying to get credit. So maybe transfer the balance over to a different card if that makes sense, but keep the original card active. Credit is harder to get in a recession. And lastly, do not panic. Recessions happen. They come and they go. Since 1990, the average recession lasted just 15 months. And there's some economists who argue that recessions are necessary, a way for the economy to burn off excess fat and get lean and mean again. There are other economists who absolutely disagree with this, but they all agree that it won't last forever. That is, if this recession is even going to happen, which, as we've learned, is surprisingly difficult to determine. So either way, plan ahead, pay off bad debt, save money, invest safely, and do it now before the refs call the play. For even more in-depth, actionable content, check out my membership site, Finova. There you'll find an insanely active investor community, coaching every single day, and research that's not here on YouTube. We're actually offering a 7-day free trial, so go ahead and check that out for yourself, linked in the description below.